Hey, good people, this is Ryan with TrendLizard.com. I hope you're having a wonderful day. Hope you're making some dough on this market rally that's popped up off the March 23rd low. It's been a pretty straight shot. It's been very intense considering what's going on in the world, but when the market moves straight, you got to trust it and you got to participate. So I hope you're having fun with that. Today, I want to post a very quick but super important video for you, and it talks about the most important thing that you need to be thinking about when you're trading. More important than your strategy, more important than the actual stock, and that is how to think about your risk. Now, when you buy $10,000 worth of Apple, you're not risking $10,000. The amount you're risking is the difference between where you entered the stock and where you're going to exit the stock at a loss. That is your risk, and I want to show you how to figure that out from a very basic standpoint and a very quick standpoint to determine exactly what your risk is, and it's a very liberating process. Once you really understand what you're risking, I think it becomes easier to be a little bit more aggressive and go into a trade understanding exactly what is at stake. So I'm going to show you a few charts. We're going to make it quick, but pay attention because this stuff's important. So let's take a look. Here we go. Okay, folks, I'm not going to inundate you with 20 different examples. I want to show you two different examples of what I'm talking about just to make the point very clear and very concise and let you know what I'm thinking. Now, as you know, we trade the Elliott Wave theory. To me, it's the most powerful stock market trading strategy out there. And I think one of the main reasons that is because there are identifiable price levels on the chart that if they're taken out, you know you're wrong. So let me give you an example here, okay? What we're looking for when we're trading Elliott Wave is we're looking for trendy 5-wave moves to determine which direction the trend is occurring, and we're looking for counter trend 3-wave moves to tell us that is not the direction of the trend. So, for example, on SPY off the March 23rd low, very current example here, we have a nice 1, 2, 3, 4, 5. That's a trendy move. That's a 5-wave move. This is the type of move that we're trying to find because it determines that, at least on this time frame off March's low, the trend is up and we should get at least one more 5-wave up leg. To confirm that, we have a 3-wave pullback off of April's high. So this is a counter trend move. We know the trend is up because of what happened in March and April. And we know the trend is still up because this counter trend pullback into May's low is a counter trend move, okay? So that tells us that the trend on this short-term time frame is up for SPY. We don't know for sure that this pullback's over, but let's say you think it is. Whatever analysis you're doing is telling you that it is. So you think that this leg that started off of last week's low is the start of the next 5-wave advance, okay? So you want to buy SPY. Now, we know that if SPY moves below 281 at any point, we're wrong, and the next up leg has not begun yet. That would tell us that it is still in this counter trend pullback off of SPY's low, or off of April's high, and that therefore we're wrong. So we can put a stop level at 281, okay? Currently, SPY is trading at 292. So if we buy it at 292 and we know we're wrong at 281, then we know our risk is $11 per share that we enter. So this can determine how many shares we want to enter, right? So if we take a look at, we know that we have an $11 risk per share, right? So if we take 11 and we times it by, say, 100 shares, then we know our risk is $1,100 that we get into. So if we're buying 100 shares of SPY at 292, if we take 292 times 100, the number is $29,200. This isn't what we're risking. We're not risking $29,200 every time we're buying 100 shares of SPY. We're risking $1,100. That's the difference between our entry level and our stop level. $1,100. That's the risk. Now, as a rule for me, I never want to risk more than 2% of my portfolio on any given trade. I'm going to be wrong. I don't want to lose a huge chunk. I don't want to get wasted every time I make a bad call. I want it to be manageable. So if I only want to risk 2% every time I make a trade, then I know exactly how much I can risk per trade. So let's say I have a $20,000 trading account. Okay, I only want to risk $400 of that. That's 2% of 20,000. So if I take the risk that I know per trade or per share is $11, and I divide that into 400, my total risk that I can take at 2% of the price of my portfolio, I know that I can buy 36 shares and I won't be risking more than $400 on that trade. So that limits my risk, and it tells me exactly what's at stake before I go into the move. Now, if we go out again to the chart of SPY, the big question is, okay, how do you come up with 281? People have a bunch of different ways to come up with their stop levels, it needs to be purposeful to your strategy. It needs to mean something. Sometimes people will just use a 5% or 10% stop level. It's arbitrary. If that's what you do and it works for you, more power to you. I think the most important thing is that you know your risk going in, whatever that is. For me, 281 represents a 61.8% retracement of this up leg right here off of May's low. If this is the start of a new uptrend, I see no reason why it should be retraced by 61.8% at any point. So if it moves back below this level, then I know something's wrong. I know that I made the wrong call, and I'm going to exit. I knew my risk. I did my homework. The hard work was done. Now it's up to the market to see where it takes us. So I hope that makes sense. Risk is everything. You're going to be wrong probably half of the time. If you're a great trader, you're going to be wrong half of the time. You need to be able to manage that risk. Make sure it's controllable. Make sure it's understandable. Make sure you can lose it before you ever get into the trade. And then when you hit the big ones and make those good trades, you let those run. So I hope that's helpful. Again, this is Ryan with TrendLizard.com. We're doing this stuff every day on our website and making the stock market and trading and Elliott Wave understandable and easy and accessible to the masses. So come visit us. Have a great day. I'll talk to you soon. Take care.